All right, 12/5/2020. We're going to start talking about some SEC filings. How many of you guys have seen my video that we did that has this in it? So Brian has. So we're just gonna run through this real quick. Efren has. Peter has. Okay. So Anant has. So let me just ask you guys a question. Do you understand it? Do you understand if I were to say to you, hey, they have a shelf registered. They have a shelf, but it's not registered. Do you know what that means for those that have watched it? Anybody knows that answer? Jump on the mic and you understand that? Okay. Um, so Anant and Peter, yeah. So um, basically, if there's an S3 on file, right? That's what Anant is saying. That's saying, hey, there's just a certain amount that they can raise. But what we're waiting for is the effect. No, 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 no. The effect. Do you know what I'm talking about, Anant? Okay. Yeah, so like a prospectus is what you're talking about, right? So the prospectus. So okay, good. So we've got some basic understanding here. So let me run through this just real quick. You guys, any questions you have, throw them in chat. All right. So a shelf registration, right? An S3. I think a foreign entity. It's called an F3. Um, oh yeah, there it is right there. So yeah, so S3 or F3. Um, is a shelf, right? And a shelf registration means a company can raise money at any time. Here, I'll just do this. A company can raise money at any time. Like Anant said, it's like, hey, we're ready to raise money, and this lasts up to 3 years and a maximum dollar amount. So a lot of times you'll see that somebody's shelf is about to expire, and they've got uh, money left that they can raise, and so they'll pump their stock up so they can finish that shelf out. Um, Now, what I'm going over is common forms of dilution, right? Does everybody understand? Typo 2 in chat if you do not understand what dilution means when I say dilution. Okay, shook. So, a lot of people on their entry exams, when I put overhead um, or dilution, you guys were talking about people that I refer to as trap traders. There's a difference between traders being trapped, right? So they long and the stock went down, and dilution, right? So basically, you're just printing out money, right? That's dilution. You're creating shares that weren't there before and selling them. So dilution is anytime a company can create new shares. That's it, right? So an S3, they're creating new shares and they're selling it. That makes the current shares less valuable. These are found on Edgar. Does everybody have this site saved? Okay, so sec.gov. This is the site. You should save this site so you can look up company filings, right? Edgar. Um, put in a ticker here and it'll let you know. Boom. It'll pull up all our filings, right? Okay. So have that site saved, found on Edgar. All right. Why shelf registration? The company doesn't have to ask the SEC each time it raises, right? They do it as many times as they want with as many investors as they can find. This is the effect, right? So they may have an S3 in, but it's not registered, right? There's no effect. And the way that this effect form works, guys, is they send in their S3 or S1, and S1s are a little bit different. But what happens is each one of them has to have an effect. The SEC looks over it and they say, well, you need to, this isn't filed correctly. You need to do this. You need to do that. And then they'll send it back. And sometimes you'll get a S1 or S3A, right? That just means they amended it. And so then the SEC says, okay, it looks great. And so the SEC is the one that has the effect, that it puts out the effect that says, okay, this is ready to use. And so they'll tell the company, and then they'll throw it on the website, the SEC website. And that's when the company can now raise. That's the SEC saying you're good to go. Many paths for the SEC usage, such as an ATM, registered direct, equity line of credit, etc. An ATM is an at the market offering. We'll go through that a little bit later. One thing you always want to check. So type a 2 if you do not know what baby shelf is. Okay. Okay. Lots of people. uh, yeah, we've got to solve this right now. Let's How many of you guys have watched my how to play Momo stocks video? It's all in there, right? It's all how to play Momo stocks. So, I can't find it on. Yeah, this is it's vital that you understand this. So let me. Does anybody have a link to that particular training via YouTube or? Oh, here we go. I think this is the shorter version. It's May 29th. Can you Efren, can you download that and can you download it and put it into the SEC, week 3? Um, so guys, I go into depth about what a baby shelf is. Google it, right? Read about it. But basically, to sum up, a baby shelf simply means, oh, look, it says it right there. Efren, slap me upside the face. It's the May 29th training. Um, a baby shelf is you're limited on the amount of money you can raise because your value of your company isn't higher than 75 million. So what a company that has 10 million shares and their stock is at $1, well, they are limited by the baby shelf rules. It means you can only raise 3 times. Sorry, raise 1/3 of your value. So a company that's worth 10 million can only raise 3 million within 12 months. That's what a baby shelf is. Um, so baby shelf means we are limited by how much money we can raise. And so there's a particular play that I use. It's in that Momo play. That's what that how to play Momo stocks training is. Watch that, where companies will try to get above their baby shelf price. And so that's on the Excel sheet that I'm going to show you later on, that's on there. You'll see something that says baby shelf, and that's all you're doing is calculating the number of shares times the stock price within a last 60-day period. So anyway, just go watch that video, and that's going to explain this. You need to have an understanding of this. It's vitally important to play SECs. If you don't understand this after watching it, just let me know, and then we'll do a session in here as well. All right. So I think we can move forward on that. All right. So let's see. A shook 2 points. Yeah, baby shelf only applies to companies with less than 75 million market value, and you can raise. Yes. Yeah, that's the main thing. Um, so I'm kind of shocked, to be honest with you, that well, I shouldn't say shocked. So I guess what it is so Brandy, you don't have access to these videos, right? So that's why you don't know it. Okay. Yeah. Okay. So I'm kind of just processing some emotions that I'm feeling here, guys. It's I want you guys to I want you guys to I want to be able to voice my emotions, right? So I'm kind of disappointed that you don't know if you have access to it. So that's kind of where I'm getting at. So if you have access to that, and I'm disappointed, and I'm just disappointed that you don't know. Now, the feedback or the thing that you could say back to me is, well, Raging Bull doesn't organize their content well, and you're exactly right. And so that's what this is for. So I'm going to process this disappointment of emotion that I feel. Okay, yes, I understand. This is what this class is for. So guys, watch that video. You have to understand it. Like, watch it 50 times if you have to. It's very, very, very important. Um, so, all right. Now, moving on from that, I'm past that. Okay. My feelings are hurt. I'm over it. Okay, whatever, right? All right. So, at the market agreement, also known as ATM, financing through shelf creates new shares. Specific amount can be raised and can be found on Edgar. Okay. So, you'll hear me say, hey, they have an ATM of 30 million. And that 30 million they've used 60 million. I mean, I'm 20 million, so they can use another 10 million, right? So an ATM is just saying, hey, sales of our shares of our common stock under this prospective supplement will be deemed an at the market offering. Okay. Now, how much can they raise? Well, this one is 40 million right here. So they have a 40 million ATM. And that means that they can sell their shares of stock. Sorry about that. They can sell their shares of stock at any point, anytime they want. It's just like us being able to hit the sell button without having any stock. We can just start bringing that money in, right? So that's an at the market offering. They're not selling to one group of individuals for a lump sum. They're not selling 10 million shares all at once. They're just slowly selling their shares. Okay. Um, so the company filed the May 2020 ATM with an aggregate offering price of 40 million. Since May 4th, 2020, and through May 13th, 2020, the company has sold an aggregate of 1.8 million shares of common stock under the 2020 ATM program at an average price of $7.34 for gross proceeds of 13.2 million. So just think about this, guys. Think about what this company is doing. They're literally hitting the sell button on nothing. They're creating shares out of thin air. That's all they're doing. So do you understand that this is dilution? So they have a company, right? This right here, HC Wainwright. HC Wainwright, they call up HC Wainwright and they're saying, "Hey, we need some money. Let's pump our stock up, and then we're going to sell into that." So a lot of times, what you'll see if you see HC Wainwright, you know that they're a scammy company. This is HC Wainwright. This is what they do. They'll say, "All right, let's PR. We just found the cure for COVID, 100% effectiveness. Remember SRNE?" But then you go and you look, and it's like, oh, they have an ATM. They've only used 13.2 million of it. they still have 30 million left. Guess what they're doing? They're going to sell the ATM, right? That's what they're doing. So understanding exactly what these people are trying to do. Now you can see dilution on tape. This is getting a little bit more advanced, goes into tape reading. You can see big bidders, and you can see, yes, thank you, Jeffries, Max and HC Wainwright Roth, they're all examples. So you can see the dilution on tape. And guys, watch tape reading 1 and 2 to get a better understanding of tape reading. But you're looking for large chunks on tape being sold off. So for example, they're not going to sell uh, 1.8 million all at one time. You're not going to see a chunk of 1.8 million, and you're not going to see 1,000 shares, whatever that is, into 1.8 million times, right? So they're going to start selling chunks off. And what happens is you start seeing these certain levels that it's a company will start getting hit. And you can see it on the chart, right? You see the distribution of these wicks up here, and you can go back and you can see on the tape, hey, there's this 100,000 block that went off. There's a, and they don't do it in even numbers. Like it'll be 999,542, right? And then there's another one for 86,627. And so you start seeing these huge chunks start going off, and that's when you can see it on the tape. This is for me, right? Shorts, right? So dilution equals good for short. If there's a lot of dilution, then it's a good short. If there's not a lot of dilution, it's a good long, right? When I say keep volume in mind, so let's just price this out. Uh, let's say they had 40 million. Well, how many can they raise? Let's just say they can raise 10 million shares. Well, if the stock's trading 100 million shares in the day, that's not going to affect the price as much if the stock's trading 2 million per day, right? So that's keeping volume in mind. You always have to keep volume in mind. So here's the math. How many shares can a company sell through an ATM? Example, 40 million. At 40 million per share, how many shares? Well, at $40 per share, average volume equals 55 million. So do you see the math? How at $40 per share, that's very, very low amount, right? They can't sell a lot. But if you change it to $2 per share, right? $40 per share versus $2 per share, then all of a sudden it's really going to impact you a lot. So this one's not going to impact you that much. High volume, 55 million, $40 per share, right? So they can raise $40 million versus $2 per share. So they're creating a lot more shares with it at $2, and the volume is much lower, so it's going to really drag down the price. Does this make sense? Does the math here make sense, guys? What I'm talking about? Okay. Okay, perfect. So Anant said, team, if this helps, this is straight from my handwritten notes. Baby Shelf applies only to companies with a public float 75 million of less than 75 million. If the public float is less than 75 million, they can raise 1/3 of the public float. Yes, that's right. Public float equals highest close price in the last 60 days times public. It's exactly right. That's Baby Shelf. Um, there's another option on Baby Shelf about anchored VWAP for the last 60 days, but that's usually not done. All right, so again, that Baby Shelf video is there. It's there to be used. And Brandy, and for anybody else that doesn't have access to that, we're going to download it so that you have access to it. Um, so when to use an ATM, cash, you need cash, right? No other forms of financing. So a company is so bad that people aren't going to to invest in it, right? Investors can't do it, so they need to use an ATM. Um, use burn rate balance sheet for cash position. Okay, that's 10 Qs, 10 Ks. That's how you figure out if a company is in need of cash. Just because it. Okay, I'm sorry. What was it? Ask me on the mic, Ashok. I didn't see it. Yeah, no, absolutely. So here, let's just go through it. If you have 40 million, right? So you've got 40. And how many shares can you issue if your stock is valued at $40, right? So divide that by 40. So how many they can issue 1 million shares, right? So that's 1 million shares printed out of thin air. Well, how many shares trade a day? Every day there's 55 million shares traded. So do you think that this 1 million shares is going to have that much of an impact on the price? Does that make sense? It's not going to have that much of an impact. So like we pull up AMD and we look at their chart. So they did 84 million. 84 million this day. If the company decides to sell 1 million shares of that, maybe we don't close at 92.66. Maybe we close at 92.30. You know what I mean? Minimal impact. Um, However, if we change that to $2 per share, right? So now let's take 40 million. We divide it by 2. Well, now how many shares can they create? Exactly, right? Exactly. They can create 20 million. Now, if they're doing 2 million a day, how long is it going to take them to dump this 20 million? If they did it every day, if they just sold every day, right? Their stock's just going to go straight down. So they can't do that, right? And so your chart ends up looking like this. So they're just slowly, hey, let me sell a million between this week. We'll sell a couple million here. We'll sell a few million here, and then it starts slowly just bleeding this down. And this is why it's so great for shorts and swing shorting is because they're using that ATM. You see it on the tape, and you can't wait for them to spike this. The Fibonacci Friday that Jason Bond always talks about? Man, that's like A plus plus short, right? Like, yeah, there's going to be a pop, but overall the thesis is still there, right? So does that make sense? Does that make it clearer? Okay, great. Um, oh yeah, thanks. Yeah, they are, Peter. Thank you. All right, so warrants. One thing you got to get familiar with if you're going to play low floats, lower price stocks is warrants. They're similar to an option. The holder has a right to buy whatever stock at a specific price, and the proceeds go to the company. Uh, the profits, the stock price minus the exercise price can be that. So the profits is if I own a warrant at $1, that means I can buy the company's stock at $1. And if the stock's at $10, I can then sell my stock at the market, right, at $10, and I profit $9. So for example, if we'll use one that I know pumps a lot. So ABio. So I own a stock, I own a warrant at $5. The stock's at $6. So you know what? I'm just going to pay the $5 to the company. So the company gets $5. I get my one share. I'm going to immediately sell that one share for $6. I just gained $1. And if I have a million of those, I just made $1 million, right? So that's what a warrant is. Does anybody need an? Yeah, exactly, Anand. Absolutely. And that's what's so great about the market. Everybody can make money, and we can be playing two totally different things, two totally different ways. We can be playing the same stock and be playing it two totally different ways, and everybody can make money. And when you're good, right, when you're real good, you decide to play both sides, the long and the short. Does anybody need a better explanation of what a warrant is? So you see right here, 4.2 million shares of common stock issuable upon exercise of outstanding warrants. So it's just like having an option to buy it at that price. Like you have a call at that price. Okay. Again, pay attention to the amount of warrants versus volume. Um, Here, let me zoom out of this. So pre-funded warrants uh, are a little different. Pre-funded warrants the company's actually already paid for them. I'm sorry, the people that have the warrants, they've already paid for them. Let me see if this pulls this up. So this document that this link I just posted will pull up this document. And so it talks about pre-funded warrants and how it's structured, and why people use them versus the 20% rule, right? That may not make sense to you right now, but read this and it will. Um, so if it's a pre-funded warrant, what happens is they paid for it at the time of the issuance of so let's say they bought 10 million shares in an offering. Well, they are also buying 10 million warrants at $1, right? So they're paying for it. So that means the company's already used it. That means they want to use these. So pre-funded versus non-pre-funded is an important detail to know the difference. And we'll go into this a little bit deeper. 9.99% ownership, 19.99% ownership, etc. There's different rules the SEC has you play by. Basically, if you're over 10% ownership, then you're an insider. Literally, you're an insider, and you have to follow different rules. So they use pre-funded warrants to stay under that. So you'll see a lot of people, they'll buy 9.99% ownership stake, and then they'll have a lot of pre-funded warrants. So Brian says, why would a company choose to do warrants over an ATM? Could they raise more money doing an ATM in most cases? I'm trying to think of an analogy here. Let me ask you a question, Brian. If I said to you, you just won the 10 million, you just won $10 million, Brian, the lottery. So here's what we can do. I'm going to give you $1,000 a week for, I don't know, the rest of your life. Or you could take the $10 million right now. Well, everything depends upon your situation, right? If you're a kid, you don't have bills to pay, maybe you take the 1,000. But if you've got debt and you've got to pay off a bill, you've got to pay off a loan, you got all, shoot, I want my $10 million, right? So through an ATM, they have to slowly drain out this ATM and sell it, and they have to pay companies to sell them out, and it's going to be over a specific period of time, and it's going to take time to do it, where you get this money, this pre-funded warrants money right now. The other aspect of this is warrants aren't necessarily for the company, they're for the investor. Warrants are part of the deal. That's for me coming to you and saying, hey, you know what? This is pretty risky. I need some type of risk mitigation, something that juices the pot, make this deal a little sweeter for me. And then all of a sudden, they're like, you know what? I'll pay you $5 per share versus $4 per share if you give me 10 million warrants at X amount of dollars, right? And so it's a bargaining tool that is used to get people to invest in companies. You'll notice a lot of the better companies, when they do raise, there's no warrants. It's just a straight up raise because people actually want to invest in these companies. But the riskier you are, the more you have to be willing to negotiate and give warrants, right? So there's two aspects to it. It sweetens the pot and you get your money quicker, right? And then for the investor, the person investing, it's their, you know what, if it is successful, if it does work, um, great, I've got these warrants. And what happens a lot of times is the company still sucks and the warrants are never even reached. And so, this is illegal, but it's done all the time. Hey, we're going to PR this so that you can dump your warrants, especially if they're not pre-funded, right? If it's pre-funded, the company has no care of pumping the stock. But if they're not pre-funded, the company's like, you know what? They can dump their stock. If we pump this above $5, and that's where their warrant is, then we're going to get that money, right? So that's the importance of understanding pre-funded versus not pre-funded warrants. Yes, yes, Brian, exactly. Um, yeah, it's exactly, Carmen, that's exactly what you're doing. They're giving an equity stake in the company, but they don't want to get over 9.99 or 19.99. It's the exact same thing. Yes, it's exactly what they're doing. All right. Now, variable rate convertibles. Let's see what time it is. I've got about 10 more minutes. Variable rate convertible notes. These are about as toxic as you can get. Um, the holders can convert debt into shares at a variable price, right? So the profit, the same thing, the stock price minus the conversion price. So let's say their conversion price is $3 and the stock's at $10 and they owe 30 million in debt, right? So they just convert and they start selling that paper, right? So I'm the debt holder and I'm like, you know what? I'm going to start taking my money right now. The stock's up. So I start converting my debt into shares at this price. And so here, let's just use the make simple numbers. uh, my conversion price is $1. Um, I am owed $1 million, right? So I convert 1 million shares. Boom, just like that. I pay the company $1 million, but the stock's at $10, and now I sell those, and I just made $9 million, right? That's how convertibles work. So XYC company issued 6 million convertible notes. Rate equals the lower of the fixed price, $2 or 85% of VWAP of the previous 10 days. So this is language that you're going to see. So the lower of a fixed price, right? So whichever one's lower. Do you see who this helps? This helps the person, the investor. So if it's $2, but well, let's look at the past 10 days. Maybe it's 30 cents, right? Um, so here's the minimum price, 30 cents. Now look, watch what happens. Toxic because continued downward pressure as holder converts, the price drops. As price drops, more shares can be converted. See how that 10-day moving average, right? So he continually increases the amount of shares he can create because he's continually bringing down the price. So as price drops, more shares can be converted. Example given: 6 million at $2 equals 5,882,353 shares. 6 million at 30 cents is 20 million shares, right? So huge difference. So every time he's selling, he's creating this downward pressure to creating more and more shares that he can just continually convert. Lower the price, the more shares can be converted. Guaranteed profit of at least 10%, right? Because 85% VWAP here, right? That's the math. Continual dilution. And these are all found on Edgar, right? So does anybody have a question about variable rate converts? I know I'm going through this kind of fast because we've done a video and there's a video on it that we can put that goes through it a little bit slower. But any questions whatsoever? No? Okay, great. Um, all right. Peter, can you explain that? No minus dilution equals toxic equals short option. Oh, no question. Yes, got it. Yes, very very simply put. Right, exactly. Um, so a private placement. So these are referred to as like pipes, private placements, right? So private investment in public equity is what it stands for. You can look up, just Google this, right? Oh, here, this link. This will pull up. This talks about pipes. You can read it, kind of go over it, but just real brief explanation of them is it's a resale registration. So what you're doing, yeah, yeah, and Anant's being honest here, right? He's saying, hey, I don't quite grasp these as well as I grasp the other things, right? That this is everything's a stepping stone, right? The reason he didn't grasp those is because he couldn't focus on those. He was still learning the previous ones. He was just learning about warrants. So guys, the what this university is for is we're putting it all out there so you can go through it at phases. As you get better with warrants and as you get better at finding S3s, well, then all of a sudden it's like, okay, I got this down. Now I can move on to understanding pre-funded warrants or convertibles. You know what I mean? It's just stepping stones. And so, um, yeah, absolutely. Yeah, thank you for being honest about that. It's stepping stones of what you'll get as you watch the videos over and over. Hopefully, what I'm trying to do here with this university is I'm creating a pathway. So Raging Bull has great information, but it's all over the place. You'd have to watch hours and hours of videos to get what you need. And something I was going to say, and I'll just go ahead and say it here is if you were to just type in SEC filings on Google, SEC filings, stop trading, and you were to pull up videos, I wouldn't say most, a lot of these are wrong. A lot of these people are explaining the filings incorrectly. Um, so like this, I know that I've listened to a couple of hers. She explains them wrong. Uh, his is wrong. This guy's is wrong. So there's a lot of wrong information out there, and so hopefully this is going to be correct information, organized, so that you guys can work your way through it. Um, for Baby Shelf, you did? Oh, okay. Yeah, yeah. So, yeah, guys, go over it as many times as you need. So, all right. So, one thing I want you to know about private placements. Oh, really? That lady you showed the video of, I actually looked at their company PR. So private placement guys, they're not as bad as normal offerings because what you're doing is um, there's already like an inside owner that's saying, hey, I want more of this company because I like it. So they may get a discounted price, but it won't be as much. So here, just a quick example of the math on private placements. Um, if there's 50 million shares of a company and the stock's at $10, if there's a private placement of a million shares at $9.50, that that's what I would qualify as a strong offering. So you, oh, hey Victor. Hey, welcome Victor. Yeah, is Parker in yet? I think so. No, I mean we still got 4 minutes for him to come in. Um, welcome to the group, Victor. Oh, okay, sounds great, Victor. So, Victor, just to kind of give you a quick overview of what we're doing here. Um, I'm a successful trader, and I see a lot of gurus in selling their service to double your account. And what happens is people buy these services and they end up blowing up their accounts, right? Because they're not teaching them trading. You know what I mean? So for me, I started I started teaching an individual named Anant here in the room, and I enjoyed it. I enjoyed teaching him, and so I've hand selected these individuals, these 12 people, 11, 12 people that we've got, um, and I've created kind of a what I called a university of trading. And I'm holding their hand to take them through how to really learn about trading. So I was talking to Parker this morning, and here I'll show you. Oh, okay, so Parker's in. Hey, what's up, Parker? So and I was talking to Parker about it, and Parker said, "Hey, yeah, I wish somebody would focus on risk management." And I told him, I said, "Hey, that's that's our number one. That's our first week, right? Because that is the most important." And so that's the goal here of what I'm trying to do. Everybody in the group has been trading for a while, a year or two, and so what we're trying to do is just get them to find an edge that they like. We're going through different edges, allowing them to have a successful trader that they can come to and review their trades, review their journals, to go make sure, hold them accountable. You know what I mean? So that's kind of what we're trying to do, Victor. And so Parker's here, guys. I'm gonna let Parker speak for himself, but just kind of give you a little background of who he is and how we met. We trade together. He's in that Discord room with me, right? And Parker, your website is Dilution Tracker, right, Parker? So, you know, and his Twitter feed is right here. So this is his Twitter feed. Make sure you're following him if you haven't followed him. Dilution Tracker and his website. So um, Parker, let me ask you. We didn't review this. What would be best for you? Do you want to? Did you create a slides that you wanted to present? You want me to just kind of go question and answer? What would be the best route for you? Okay. Yes. Efren, can you make him a presenter? I'm just now seeing that. Um, stock dilution here. Okay. Yes. Thank you. Thank you. So here I'm going to stop this recording.